Manager. Before we get started, I need to display some important disclosure information for everyone. Obviously, there's a lot in there. It's going to take some time to review. If you'd like some more time to review, please reach out to your advisor and he can provide you a copy of the presentation. Okay, getting started with today's agenda. First of all, we're going to let Peter give everybody his update on the economy and his outlook. Then I want to get into a quick review of what's happened in the first quarter of 2017, look at our 4 key themes that we spoke about at the beginning of the year and see where we are today. And then I want to talk a little bit about some of the strategy comments that we'll be sending out to our clients probably tomorrow. We're going to be discussing some cycles that we see in the market and what it means for the future. And then we'll leave as much time as possible for Q&A at the end. So without any more delay, I'll introduce Peter. Peter, please go ahead. Peter, you gotta, I think you're on mute.
Yeah. Oh, sorry about that. All right. Hi, everybody. Thanks for joining us this evening. And yeah, I'm going to talk more about the psychology of the markets and the strategy. Then I'm going to talk about the economy. But I'm going to start off just a little bit on the U.S. economy, which has evolved or maybe devolved pretty much along my expectations. If you remember on this call early in January, there was a lot of enthusiasm for the U.S. economy. A lot of it was related to the surprise victory for Donald Trump. Not a surprise to me, but a surprise to a lot of people who didn't understand how bad the economy was, which is why he won. The Fed was very optimistic on GDP growth for Q1. In fact, as late as February 1st, they were looking for 3.4% GDP growth in Q1. They're now looking for 0.6. That's almost 3 percentage points lower. And in fact, on Friday, they're going to meet again, and I think they're going to lower it down. They're going to be close to 0. And who knows, by the time we actually get the Q1 number, it could be a negative print, which means we're halfway into recession. Of course, I think we've been in recession for a long time. I just don't think the inflation number is accurate. I think it's too low. And so I think we're turning recession and we're masquerading it. So it looks like it's a slow growth economy when it's actually a contracting economy. And that's the reason, that Donald Trump is now the president. But I think that, the Fed is continuing to either lie about the economy and talking as if it was still strong, trying to engender some confidence, or they're just completely oblivious to what's around the corner. And remember, they were oblivious to the 2008 financial crisis, and that was as obvious as could be, yet, they couldn't see it. And they're still talking as if they're going to raise rates 2 or 3 more times this year, when they're probably going to be cutting rates. They're probably going to be launching QE4 because cutting rates will do nothing at this point. I mean, it's not enough stimulus to go from 0.75% to 0, especially when you have a bubble this size, because this bubble is far bigger than the one that popped in 08, far bigger than the one that popped in 01. And so the Fed is going to have to come back with an even bigger stimulus than it did in the past. And so, if you thought QE 1, 2, and 3 was big, QE 4 is going to have to be bigger than all 3 of those combined. And I think we are going to overdose on stimulus. And if you recall from the beginning, when I wrote my book Crash Proof in 2005 and 6, and it came out in 2007, the crash that I was trying to protect people from is not the one that happened in 08. It's the one that's about to happen. And I'm surprised it's taken so long, right? When I wrote my first book, I said that we have this housing bubble and it's created a phony economy. It's because of the Fed. The bubble's going to burst. I said we're going to have the worst recession since the Great Depression. We're going to have double-digit unemployment. We're going to have trillion-dollar budget deficits. We're going to have a financial crisis. Fannie Mae and Freddie Mac are going to go bankrupt. All the stuff I said was going to happen, and it all happened. And I also wrote that the government, the Federal Reserve in particular, would repeat all the mistakes that caused the problem. They would try to reflate the bubbles in stocks and real estate. And as a result of that, the dollar would crash, and that would crater the economy, and that would be the real crisis. I said we could survive the bursting of the housing bubble. What we couldn't survive was going to be the dollar crisis. That is the only piece of the puzzle that hasn't come to place. And the reason is, in 2008, the dollar was at an all-time record low, and it actually rallied. And because the dollar was rallied, we didn't have to fix our problems. We were able to get away with all the stimulus that made our problems worse. And now the reality is the economy is so much more screwed up than I ever thought possible. The malinvestments are so much bigger. The bubble so much bigger. It's going to be so much worse. And we've had to wait a while. But as a result of this, the profits that I thought my clients were going to make on my strategy are now going to be much, much bigger than I anticipated because of the problems having been allowed to get so big. And it doesn't matter that we had to wait a few more years because, you know, the type of profits that I think we're going to make are worth waiting for. You know, I've made a lot of money twice in my career as a stockbroker, for myself and for clients that were following my advice. The first time was the bursting of the dot-com bubble. And I didn't make money because I was short the dot-com stocks. I wasn't short. What I was doing in the late 1990s was buying the gold stocks and the oil stocks, and I was buying, you know, stuff in Kazakhstan and Russia. I was buying stuff, old economy that nobody wanted. And I knew that when the stock market bubble bursts, the Fed was going to do what it did, and it was going to, you know, inflate. It was going to cause gold to go up and oil to go up and the dollar to go down. And so I positioned for that. And the bubble got bigger than I thought. You know, my clients were losing money for a few years. But then in 2001, the bubble burst, and we just printed money for 7 years in a row. I mean, the returns were phenomenal. You know, we so much more than made up for the money we didn't make in the dot-com bubble. And the difference was my clients kept their profits. The people who were profiting in the dot-com bubble lost it all. You know, and then the second time I made money was shorting subprime. And, you know, that trade didn't happen overnight. I understood the housing bubble. I was warning about the housing bubble as early as 2002. It didn't pop until 2007. So it took a long time to make that money betting against housing. But when it paid off big, right? You got to be patient. And now we're at another point. And I have never been as confident as I am right now. And, you know, when I first started really pounding the table on these calls for clients to add to their accounts in a big way was January of 2016. And as it turns out, that was the exact bottom of our strategy. And we've had a good rally. Most of our strategies beat the U.S. stock market last year. And the only reason that some of them didn't was because of that bogus Trump rally at the end of the year, which I'm going to get to. But this year, we're killing the U.S. stock market again. And you wouldn't know that. I mean, the Dow is up 4.9% on the year, including dividends. And the S&P 500 is up 5.4%. Gold is up 11.7%. 11.7%. Here's our funds. Our bond fund is up 4.6%. But my dividend payers fund is up 6.8%. My value fund is up 10%. My emerging market fund is up 13.8%. And our gold fund is up 15.7%. Those are the year-to-date returns. In fact, if you take the average of our 4 equity funds, they're up 10.2% year-to-date. No, 11.6% for the 4 equity funds. It's 10.2% if you average in the bond fund. So we're still well more than double the return on the S&P 500. And remember, that's net of our fees. The S&P 500, the Dow, when you look at that, there's no fees. It's just an index. And so the returns last year beat the S&P, and this year beat the S&P. But one of the things that's got me so excited about this is looking at what my clients are doing. The last time we had a lot of clients throwing in the towel and closing their accounts was in the first quarter of 2016. And that was right before a big rally. In fact, our value strategy was up about 35% in the first half of last year. And my gold fund between January of last year and summer tripled in price, tripled. Yet we had redemptions, lots of people redeeming at the lows in January and February. And that was the biggest amount of people closing their accounts that I've had in years, at that point. And I talked to everybody who closed their account. At least I tried to. Not everybody, I don't get a hold of everybody, but I talked to most of the people. And the people that I talked to back then, they were still worried. They weren't cashing out of their accounts with me to go into the U.S. market. They were going to cash. Obama was still president. Everybody thought Hillary would replace him. It looked bleak. People were still worried about the economy, but they were giving up on my strategy because, they sent me money a few years ago. They were down, and so they were just going to go to cash. They weren't going to do anything. That was the attitude. This quarter, I think we've had more clients, individual clients, closing their accounts this quarter than that quarter. It's been every day, 1, 2, 3 clients have closed their account. They've transferred out, they've liquidated their accounts. And I talk to them again. I call them up. Now it's different. They're still citing performance as a problem, even though we're beating the U.S. market this year. And I've talked to people who are closing their accounts, and I point out, your account is up 30% since January of last year, 30%, and they're closing because of performance. And they'll say, well, but I started 4 years ago, and, I'm still down 5%, or I'm only up a little bit. I would have been better off in the U.S. stock market. Of course, yes, you would have been better off in the U.S. stock market because the bubble got bigger. Just like people who followed my advice in 1997 would have been better off if they stayed in the U.S. stock market. But if they were still in the U.S. stock market in 2002, they lost a ton of money. And they made a bunch of money following my advice, right? And so, yes, in hindsight, people would have been better off if they bought the U.S. stock market a few years ago, but only if they sell now. But what a lot of my clients who are closing their accounts are telling me they're going to do is they're buying the U.S. stock market now. They're not getting out of my strategy to go to cash. They're getting out of my strategy to buy U.S. stocks. Now, why is that? Well, if you look at the confidence numbers for consumer confidence, for small business confidence, it's skyrocketed recently. Why? Because Donald Trump is president. And the Republicans, and most of my clients are Republican, not all of them, but the vast majority. Some are, we got probably more libertarian clients than Democrats, but mostly Republicans. And they sent me money because Obama was president, and they were worried about the economy. They were worried about the things that he was going to do. And the reality is, Obama screwed up this economy probably like no president has screwed up an economy in memory. But the problems were covered up by the Fed, which was even more reckless than it was in the past. And so their mistakes are even bigger than Obama's mistakes, but they covered it up. And they inflated this huge bubble in the stock market. So all the problems that my clients were worried about that were going to result from Obama, they're still here. They're still going to happen. Just they're going to happen under Trump. It's going to fall apart while Trump is president. Yet my clients are all of a sudden think that everything is great, that the problems that they are worried about don't exist anymore because Donald Trump is going to save us. Donald Trump's going to make America great again, right? We're going to win so much, we're going to get tired of winning. We're going to want to lose for a change just to break up the boredom of our constant winning. And all this hype is a bunch of nonsense. I've said this all along. I mean, he is not the second coming of Ronald Reagan. I mean, more likely he's the next Jimmy Carter because he's walking into a minefield. That is the problem. This is all going to blow up on his watch. Meanwhile, all the enthusiasm that people had over Donald Trump, right? He was going to get rid of Obamacare. Oh, no, he's not. I was saying that the last couple of months. I said, these guys are not going to repeal Obamacare. And guess what? They're not. We're not even going to get significant tax reform. In fact, we're not going to get tax cuts until this economy is in a recession. And then we're going to get an economic stimulus package. And I also warned about the fact that Trump was going to align himself with the Democrats. And that's what he's doing because he's fighting the conservatives in the Republican Party. The Tea Party, the Freedom Caucus, these are the guys that really want to make a difference. These are the guys that came to Washington to drain the swamp before Trump even knew about the swamp, right? He wasn't even thinking about this. And he is not working with the Freedom Caucus. He is working against them. He is working with the mainstream of the Republican Party. He's working with the neocons. Why do you think he's dropping bombs on Syria? Right? This is business as usual. So the only thing that's positive about Trump is that if it hits the fan early enough in his presidency, he's more likely to try free market principles than Hillary Clinton would have. But prior to that, he's not. This is business as usual. And so you have all of my clients who are just they're just basically capitulating, right? They're like, I can't take it anymore. I'm getting into the U.S. stock market, right? They watched the U.S. stock market go up for years, and they never even thought about buying. Now all of a sudden they want to buy. Well, that's the same mistake that people made when they waited out the move under Clinton and decided to get into the stock market when George Bush won. They were buying into a bubble. People buying into the stock market today are buying into a bigger bubble. Meanwhile, I think the dollar bubble that we have now is bigger than the dollar bubble that we had then. And you know, the enthusiasm that some Republicans have for Trump reminds me of all the enthusiasm that a lot of Democrats had when Obama was elected, particularly the African-American voters who were so, oh my God, this is fantastic. We finally have a black president. All my problems are over. You know, all these white folks didn't care about me, but now that we have a black president, I'm never going to have to worry about anything. I'm not going to have to worry about my rent. I'm not going to have to worry about food. I mean, everything is going to come for free from the government. This is what people actually expected. And of course, none of that happened. I mean, African Americans suffered more under Obama probably than any other class, right? I mean, his policies were a disaster for the people who enthusiastically voted for him. And I think the Republicans are going to be just as disappointed because they have expectations that are impossible to be met. I mean, Trump said a lot of things to get elected that resonated because the economy was a disaster. And he acted as if he can cure the problems by just being a smart negotiator. But just because he's an outsider, look, Jimmy Carter was an outsider. He was only a one-term governor from Georgia, right? I mean, what was he? I mean, he was a peanut farmer. So they thought, okay, you know, let's let a peanut farmer run the country. He can't, you know, maybe he'll do it better than all these career politicians that screwed it up. But, you know, he walked into a bad situation. Well, Trump is walking into a worse situation. He's working into a worse situation than Bush did. So the fact that you have all these clients, and again, as a percentage of my client base, it's still small, but it's a lot of people. I mean, you talk about, you know, every day, 1, 2, 3 accounts closing. So, you know, maybe you're talking about, you know, 100 accounts to 200 accounts out of like 20,000. So, you know, not that huge. But to me, this is a big deal to see and to talk to these clients and to get their perspective and get their pulse and try to put the facts in front of them. Like, hey, forget about the fact that, you know, your account hasn't done well over the last 4 years. Look at what it's done the last year and a half. I mean, your account stopped losing money in December of 2015. I mean, people are telling me, hey, I'm tired of waiting for this strategy to work. The wait is over. The wait ended in December of last year. It's working now. And the gains that we've seen now are tiny compared to the gains we're going to get. I mean, people have no idea. The dollar index is still at a 14, 15-year high. I mean, we're making these good returns now. The dollar hasn't even fallen yet. Wait till you see what happens when the dollar falls. I mean, a lot of people who are clients of mine now were not clients in 2002, 2003, 2004, 2005. You have no idea how this strategy performs when the dollar is weak. You know, people haven't seen it. People got a small taste of it in 2009 if they were clients then. But almost every year was like 2009 and 2003, 4, 5. I mean, we were crushing it year after year after year. But unfortunately, you know, a lot of people didn't know about me until they read my book in 2007. So, you know, they came into my strategy when we had all these good years. But we are preparing, I think, for the best returns that I've had. In fact, in my personal account, I have more margin debt now, both in absolute number and as a percentage of the value of my account than I've ever had. So I am personally borrowing money to buy foreign stocks, borrowing money to buy gold stocks, right? And that's how optimistic I am that all the people who are piling in, all the lemmings who are buying into the stock market at a major, major valuation peak. Meanwhile, the weakness in the economy, I remember in 2008 when I was going on television talking about how weak the economy was, and nobody could see this recession coming. It's even, the data is even worse now. In fact, if you look at what's happening in the retailers today with store closures and bankruptcies and now layoffs, they're laying off people now in retail. The retail sector is in worse shape than it was in 2008. That's the year of the financial crisis. We haven't had the crisis yet, and the retailers are in worse shape. So this disaster is so big, and sometimes the bigger the problem, the bigger the bubble, the fewer people can actually see it. So I'm going to reiterate this again on this call. People have got to take advantage of this before it gets out of control, right? Before the dollar really starts to tank. I mean, gold now is at 1285. I mean, once we get 1350, I think it's going to take off. I think it's going to move up very, very quickly. Gold stocks, you know, even though gold's up almost 12% this year, gold stocks only up about 17%. They should be up 40%. This is a gift horse. You know, you should just be gobbling up these stocks right now. And I think the reason they're not going up is because there's still so much skepticism, right? Oh, the Fed is raising rates, right? That's supposed to be bearish for gold. No, it's not. I've been saying that the whole time. Gold's done nothing but go up ever since the Fed hiked rates. Oh, the Fed is hiking rates. It's going to be bullish for the dollar. It's not. The dollar has stabilized. The dollar hasn't gone up. The dollar peaked a couple of years ago. I mean, it's, you know, it double topped. But what people don't get is that these rate hikes are too little too late. They've already been discounted into the market. And these are nominal rate hikes. The inflation rate is rising faster than the Fed is hiking rates. Meanwhile, the tightening cycle is practically over. The market is not even anticipating the easing cycle. And this is going to be the easiest money ever. And what's going to happen is they're going to have major budget deficits. Trump is going to come up. He's going to work with the Democrats. They're going to have a huge infrastructure bill. They're going to have tax cuts for the middle class. They are going to blow a hole in the deficit so wide, we're going to run up to $2 trillion deficits this time. Not $1 trillion, $2 trillion, right? The Chinese, the Saudis, they're already selling our bonds. When we did QE1 and 2, the world stepped up to the plate big time. Foreign central banks stepped up to the plate and loaded up on U.S. treasuries. They're not going to be there this time. The only buyer is going to be the Fed. And in fact, they don't even want to. Trump is accusing people of being currency manipulators. The last thing anybody wants to do now is start buying up U.S. dollars to try to prevent their currency from rising because they'll be labeled a currency manipulator. So it's the perfect storm. It's all coming. I can see it crystal clear. It's bigger than the dot-coms. It's bigger than the housing bubble. This is where I think the most money is going to be made. That's one of the reasons I moved to Puerto Rico, because I don't want to pay capital gains taxes this time. I paid enough capital gains taxes on the subprime. I paid plenty of capital gains taxes early on. And, you know, I just, you know, this is going to be huge. I don't want to share this. I don't want to have to write that massive check. So, you know, but if you have money in the U.S. stock market, sell. There is no upside in the U.S. stock market that's worth the downside risk, right? Talk about, you know, picking up pennies in front of a steamroller. If the U.S. stock market continues to rise, it's going to rise at a much slower pace than the foreign markets. I mean, the emerging markets, no one is talking about how much these emerging markets are up close to 20% this year, with 17, 15, 16. I mean, no one is talking about this, right? Everybody jumped on the Trump train. They're on the wrong train. The train is in the emerging markets. The train is in gold. So if the U.S. market keeps going up, it's going to go up much slower than the foreign markets. If the U.S. market tanks, which it could do, foreign markets are not going to go down nearly as much, especially the defensive names that we own, and the gold stocks are going to go up. If the U.S. market tanks, these gold stocks are going way up. But more importantly, the dollar is going to go down. And that's what drives my strategy. My strategy is all about a weak dollar. We haven't had a weak dollar. When we have a weak dollar, that's when everything is going to pay off. In fact, when we were losing money in 2015, my stocks weren't going down. Other than my gold stocks, my other stocks weren't going down. Many of them were going up. You just couldn't see it because the dollar was going up more. I think that even if the U.S. stock market tanks 1,000 points, 2,000 points, our foreign stocks in dollar terms will go up, because even if they go down in local currency terms, they will go up in dollar terms, and the gold stocks will go way up. So I think either way, if the U.S. market goes down, you're better off having money, you know, with me. And if the U.S. market goes up, you're better off having money with me. And the returns are not just going to be, you know, 10, 20%. They're going to be much, much higher. In fact, if we're already up, the average of my 4 equity funds is already almost 12% this year. We're a quarter of the year through. So if we just compound the last quarter for the rest of the year, you're at close to 50% gains. But, you know, I think the second half of the year is going to be much better, because I think the second half of the year, you're going to have a weak dollar. We haven't even had that yet. We don't even have the tailwind yet. So if you haven't taken advantage of the opportunity to add to your account, you got to do it. And if you have money in the U.S. market, you got to sell. I mean, there's no reason to do that. You got to take those profits while you have them. Don't watch them evaporate, and you got to take advantage of where the dollar is right now. Forget about the fact that, hey, I sent you money 4 or 5 years ago, and my account's barely up or it's still down. This is an opportunity that you wouldn't have had the dollar collapsed 4 or 5 years ago. Yes, we would have made money right away, but we wouldn't have made nearly as much as we're going to make now, because this is a much bigger problem. The dollar has to fall much further now than it would have fallen had it fallen 4 or 5 years ago. We're going to make a lot more money, but we also have the opportunity to add to our positions, right? To press our bets when it's obvious they're about to pay off. And if you happen to have had money in the U.S. stock market, you made money out of dumb luck. Take advantage of it and take those winnings, and not just the winnings, take the principal and invest it, because that's what's going to really make a difference. 4 or 5 years from now, the fact that the accounts went down 20 or 30% before they quintupled or whatever they're going to do, it's not going to be anything. It's all going to be a bunch of noise. It's not even going to matter. But what will matter is the fact that you added, right? The money that you put in extra, right? Especially if you added while you're still down. That's what makes a huge difference. One of the stocks I own that made a new 52-week high yesterday, it's now up like 80% on the year. It's a stock that I started buying it like 10 years ago. And of course, it went way down. A lot of the stocks that I buy go down before they go up, because I'm a value guy. And, I buy things I think are cheap, and they tend to get cheaper. So this is a stock, and I bought 60,000 shares of it. And then when I was down about, 70%, I doubled up. And so now on my position, I'm up about a little over 100% on the entire position. But on the extra shares that I bought, they've like quintupled or, up fourfold, since I bought those. Meanwhile, the dividends I've got on the stock exceed my entire cost basis anyway over the time that I've held it. So the position I have for free. But the reason I have such a huge gain is because I took advantage of the fact that a cheap stock got even cheaper. And I was able to take advantage of some idiot that wanted to sell it at a ridiculous price. And there are a lot of stocks in my portfolio that fit that bill that I was buying 10, 15 years ago. That it just, but I was, there's stocks that I was down on 5, 10 years after I bought them, and I ended up making a ton of money on them. Time is not my enemy. Time is my friend. I get paid to wait. I get dividends. And the fact that we had to wait to get paid, it's not going to work against us, right? And that's one of the reasons that I didn't use leverage. I don't use options. One of my clients emailed me about, he said, Austrian economists are typically bad investors, right? And he said, well, and I fall into the same trap, right? I'm a bad investor because my accounts were down based on, a particular point in time. I disagree. I think Austrians are great investors if they have the patience. The problem is, it's hard to be a trader, a short-term trader, and be an Austrian, because when you see things that everybody else has got backwards, in the short run, it's a voting, right? The investment returns reflect what the majority of people believe, right? Because that's where the money is flowing. So if the majority of people are fools and believe something that's not true, in the short run, that the stuff they're buying is going to go up. In the long run, it's going to come crashing down when they get blindsided by things that I've been seeing for years. So you just have to be patient. I've made a lot of money as an Austrian, understanding the credit cycle. It let me make that money with the dot-com bubble burst. It let me make all that money on the subprime market, and it's going to enable me to make all this money now. It's just the people that don't understand economics that end up, getting sucked into these bubbles, and then they end up losing a fortune. But even if you go back, you go back to 2001, the only years really that we underperformed the U.S. market was 2008 and 2013, 14, and 15. That's it. But the problem is I have a lot of clients that were not with me from 01 to 2011 or 12, but they were with me in 13, 14, and 15, and so they have that perspective. And even though they've made back a lot of those losses in the last year and a half, they still look at their 4 or 5 year performance and think, I would have been better off with the U.S. stock market. That's true. But just wait another year or two, and that won't be the case. The people of the U.S. stock market are going to be down, and I think, we're going to have huge gains. So with that, let me turn it over to Jim. And excuse my cough. I've been coughing all day.
All right, thanks a lot, Peter. So what I'm going to do now before the Q&A starts is, first of all, I want to review the first quarter of 2017. And what I want to do is just take a look at the 4 key themes that we laid out at the beginning of the year and update you on the progress where we are. So the first key theme that we spoke about was that slowing U.S. growth was underappreciated. And what we mean by this is that the consensus estimates for GDP growth in prior years have consistently been higher than where GDP eventually settles in at the end of the year. We think that's going to be the same case for 2017, and it's related to our second theme that the Fed tightening cycle is ending, but I'll get into that soon. But looking specifically at the first theme, slowing U.S. growth is underappreciated. So at the beginning of the year, consensus GDP was looking for 2.2% growth. It's still sitting at 2.2% for the full year. However, if you look at the first quarter, they've been starting to inch their numbers down. So they're pushing that growth out into later quarters. We don't think that that's actually going to come to be, and expect that the overall GDP number will be much lower than 2.2% for 2017. But the important thing that we can focus on with respect to this particular theme that we spoke about is what's happened with the Atlanta Fed's GDP Now model. That projected a first quarter GDP growth number of 3.4%, and it's now sitting at 0.6. So that's a huge drop. So from our perspective, it looks like the first theme is progressing as expected and will continue to do so as the year goes on. Looking at the second thing we spoke about at the beginning of the year was that the Fed tightening cycle was basically coming to an end. And where we differ with the rest of investors on this perspective is we believe that the Fed's tightening cycle actually began in 2014 when they started tapering the quantitative easing program, whereas most investors think that the tightening cycle actually began in December of 2015 when the Fed hiked their first quarter basis point. So given that perspective, it's obvious to see why GDP growth is consistently coming in below expectations. That is, the Fed actually started tightening a lot sooner than everybody expected, and that's been tightening financial conditions and putting a brake on growth. With respect to this goal, however, Fed tightening cycle is ending. You can see it in the performance of gold. You can also see it in the fact that the 2-year yield is unchanged on the year. Like every time the Fed has hiked interest rates, we've seen a rally in gold. To us, that means the market is sniffing out that the Fed really is closer to the end of their tightening cycle than the beginning. And the market is sniffing that out, and that is why gold is performing well, even in the face of Fed rate hikes. The third, so that theme is progressing as expected as well. The third theme we spoke about at the beginning of the year was that U.S. equity performance was vulnerable and that gold was set to outperform. If we go back to the December 2016 Fed hike, we see that gold miners are up 20% since that point, whereas the Russell 2000 is only up 1%. So that theme is playing out as expected as well. And the fourth theme, we expected to see euro appreciation and also appreciation of other currencies, plus a good performance from gold in emerging markets, because gold and emerging markets tend to be positively correlated with the performance of the euro. And the reason that we expected euro appreciation is that we, like I said before, we think the Fed is a lot further along in their tightening cycle than most believe, and they'll be flipping a U-turn and getting easier going forward, while the European Central Bank will probably be getting a little bit tighter with respect to monetary policy, given a pickup in growth that we see in the Eurozone. So if you have that differentiation in monetary policy where the Europeans are getting tighter, but the Americans are getting looser with respect to monetary policy, that should drive the euro up. And if we look at how the euro has performed since we came out with this theme, if you look at since the December 2016 hike, the euro is up 2%. The Stocks 50 index, which is European stocks, is up 12% in US dollars. And the Russell 2000 is only up 1%. So that theme is progressing as expected as well. Now we expect a little bit of volatility as we move through the elections in Europe, particularly the elections in France. However, post-elections, we expect the upward momentum to continue. So looking at all 4 themes, they seem to be progressing as we expected. That's been providing a tailwind for our strategies, and we expect them to continue through the remainder of the year as well, and expect them to continue to provide a tailwind for our strategies. So looking at the first quarter, everything is kind of going as expected, and we expect that to continue. Now, I quickly wanted to point out a concept that we're going to be sending out to clients in our investment update. Probably you'll get this tomorrow, but I thought it was important to bring up in the presentation as well, because it really helps to answer this question that Peter was talking about. You know, should people be going to invest in the U.S. market right now because Trump has been elected and he has a lot of pro-growth policies? Is that going to help U.S. stocks? You know, our answer to that question is absolutely no. U.S. stocks are extremely expensive. And if we pay attention to where we are in terms of these long-term economic cycles in the U.S., it doesn't support investing in U.S. stocks either. So if we take a look at this chart, what we've done is divided U.S. economic long-term cycles into leveraging periods and deleveraging periods. So when we're going through a leveraging period, the U.S. economy is taking on a lot of debt, and we're going through a deleveraging period, the U.S. economy isn't losing debt, they're just not growing it as fast as they were before. And the thing that's interesting about breaking up the U.S. economic cycles into leveraging and deleveraging phases is that when we're going through a leveraging phase, what tends to happen is that the dollar falls and gold miners outperform U.S. stocks. And when we're going through a deleveraging phase, the dollar tends to rise and gold miners underperform U.S. stocks. So taking a look at this chart, there's a lot of lines and there's a lot more explanation in the investment update. But the important thing to keep an eye on as I kind of explain this chart is the dotted black line. And you can see from 1982 to 1990, that dotted black line is steadily rising. Okay, so this was a 7.7 year duration phase of leveraging where we saw total credit increase by 28% in the U.S. economy. Over that period of time, we saw the dollar index fall 28% and gold miners rise more than the Russell 2000, up 118% versus the Russell's 84% move. Then we went into a period from 91 to 2001, which is 9.9 years long, which we would basically call a deleveraging phase. We didn't see credit decline, but it only increased by 1%. Over that period of time, we saw the dollar index up 21%, gold miners down 40%, and the Russell up 179. Then we went into the next period from 2001 to 2007, which lasted about 6 years. And we saw credit increase by 22% in the U.S. economy, a dollar index fall by 35%, gold miners up by 367%, and the Russell 2000 up only 65%. Now for the phase that we're in today, it began around 2009, and it's extended until the current period, but we believe it's now ending. But this phase has been 7.8 years long. It's been a deleveraging phase because credit has only increased by 4%, right? Mortgages continue to decline. Over this period, the dollar index was up 25%, gold miners down 39%, and the Russell up 173%. So this is what's happened in the past. And what can we kind of take away from this to think about how the future will play out? Well, on the next couple of slides, I'll show you how today is very similar to what we saw in 1998, 99 before we entered the leveraging phase from 01 to 07. But what we essentially believe is that the U.S. is ending this 8-year deleveraging phase, which saw the U.S. dollar appreciate and gold miners underperform. And in the coming years, we'll be entering a re-leveraging phase where we'll see a lot of fiscal stimulus from the government, total credit rise, and we expect under that environment for the U.S. dollar to fall and gold miners to outperform U.S. equities, similar to the period in 2001 to 2007. An important distinction and important caveat to all this is that we still maintain, and Peter mentioned this as well, we maintain that in order for President Trump and Congress to get any kind of significant stimulus passed through, something needs to happen that's bad first. Okay, we don't think they're going to be able to push anything through under the current circumstances, given the positive outlook on the U.S. economy. So something bad needs to happen, and that bad thing is probably going to be a recession. And that bad recession is probably going to be driven by the Fed hiking into a slowing economy, which kind of gets back to our second theme, our first theme, which was that slowing U.S. growth is underappreciated. Okay, so let's go to the next slide and just take a look at why we think this period is matching up nicely for another releveraging period like we saw in 2001 to 2007. So what we've seen over the last 18 months looks eerily similar to what we saw in beginning in the fourth quarter of 1998. So if we start with that and we look at the chart on the bottom right-hand side of this slide, essentially what happened is we got a decline in economic growth, and we're showing on this chart economic growth as the Purchasing Manager Index, which is the blue line. You can see the blue line falling, and then following that is a correction in the Russell 2000, down 37%. So that decline in economic growth prospect and the decline in the Russell caused the Fed to react and cut rates by 75 basis points in the fourth quarter of 1998. What that did is essentially ease financial conditions enough to cause a releveraging in the economy of more economic activity. You saw the PMI move back up, and with the increase in the PMI, you also saw the Russell rally to a record high. What this did is kind of put the economy in a viewpoint from the Fed's view that the economy was getting so much better that they could start hiking rates again, which they began to do, and they hiked the economy right into a recession. Now, if we look at where we are today or what's happened over the last 18 months, it's very similar to what we've seen back in 1998. So coming over to the slide on the bottom left-hand side of this the chart on the bottom left-hand side of this slide, it's very similar to what we saw in 1998. So if we look at what happened, the Fed hiked interest rates by a quarter point in December of 2015, and we subsequently saw a pretty aggressive market correction all the way into the Brexit vote, which was mid-2016. Over that period, the PMI numbers were steadily coming down just as they were back in 98, and we saw a correction in the Russell 2000 of about 26%. This caused the Fed to implicitly cut, and we've discussed this concept in the past. The Fed didn't really have any room to actually physically cut interest rates. So what they did was what we call an implicit cut. And the way they did that is that they communicated to the market in the first quarter of 2016 that the longer run interest rates where they would settle in over the long run would be lower than they'd previously thought, lower by about 65 basis points. And they communicate to this to the market using the dot plot chart they published. And the median of the dot plot chart for where they expected long-term interest rates to settle in was 65 basis points lower than they had previously thought. So this is them communicating to the market, hey, we're going to cut interest rates less than we previously thought. That's kind of as good as a cut because it's signaling to the market that they're not going to hike as many times as they previously thought. So that implicit cut that we're talking about also eased financial conditions similar to the period in 1998, which caused an increase in economic activity similar to what we saw in 98. So we've seen these PMIs grow once again in the second half of 2016 and into the first quarter. And we've also seen a rally in the Russell 2000 as well, now back to near record highs. So these two periods are very, very similar. And let's go ahead and move to the next slide and kind of talk a little bit about what might happen going forward if indeed we are in a similar period to what we saw in 98, 99. First of all, let's take a look at the PMI. So this chart on the bottom left-hand side of the slide is looking at the 6-month moving average of the PMI numbers from 1984 to 2002, and that's overlaid perfectly in time series with the blue line, which is the period of 2002 to present. So it's very, very close. If you look at this, you see both the blue line and the red line roll over here in 2015. It looks like it's a little earlier than it is because it's the moving average. And then you see it pop right back up as a result of the 75 basis point cut in 1998 and the implicit cut in the first quarter of 2016. What happened after that historically is, like I said, the Fed continued to hike interest rates, and you saw this PMI number roll right into the recession, which is the shaded area right here. And the Fed's in a very similar place than they were in 98. I mean, they're talking about, they've already hiked once in 2017. They're talking about hiking another 2 times this year. They say they may even hike more if economic conditions permit. It's very, very similar to the previous period, and it could be that they just hiked the economy right into a recession similar to what we saw in 2001. Okay, if you look at it in terms of non-farm payrolls, which is the chart on the bottom right-hand side of this slide, it's a very similar picture as well. This is a 6-month moving average of the non-farm payroll number, and you can see this leg down is very similar to the initial leg down leading into the 2000 market crash. And it could very well be that if the Fed continues to hike interest rates, you'll see these non-farm payrolls drop into negative territory. Just one more slide to kind of talk about where Fed policy rates were before and where they are now. So you can see here the red line is historically, and the blue line is currently today. And so you can see here where the Fed cut interest rates by 75 basis points, it caused an increase in economic growth numbers, it caused an increase in the market, and then you can see the red line steadily rise as they hike, and they hiked us right into a recession, and they ended up dropping interest rates to record lows again. So where we are today is very similar. The Fed engaged in this implicit cut following the market correction in the first quarter of, you say the first half of 2016, and now they're starting to hike again. If they continue on that path, it's very likely they'll hike us right into a recession again, but this time they won't have much room to cut interest rates. Like Peter was mentioning, it's likely going to be a quantitative easing program much larger than any of the previous quantitative easing programs. And it's also likely to result in significant fiscal stimulus from the Trump administration, which would be, in our view, very, very positive for our strategies. It would signal an outperformance of gold, outperformance of foreign currencies, outperformance of foreign stocks versus U.S. stocks. So if we are indeed in this period that's similar to 98, 99, and we're entering a new 7-8 year cycle similar to 2001 to 2007, we think that our clients are positioned very, very well. Right now, we're in defensive stocks with precious metal exposure. So if we do get this initial market correction, we're positioned very defensively, and then we can get positioned more aggressively after the correction happens. But whether it does or not, we're positioned very well going forward, and we think we're in very good shape. So that pretty much covers my part of the presentation. I have looks like I already have a couple of questions here, but I'm going to need some time to look through some of the questions and get them over to Peter. If you do have a question that you'd like Peter to answer for you, please find the questions box in your GoToWebinar control panel. You can type your question in there and I'll pick it up. And while I'm getting these questions ready, Peter, do you want to just answer that question again that we got emailed in? The question was asking how our funds are protected if the market crashed, and has EPC considered hedging their?
I can't. Oh, now I'm unmuted. All right.
Okay.
Sorry for that. Yeah, in fact, there's a question I wanted to answer that one of the reps just forwarded to me from a client who's listening now. And his question, he was looking at our portfolio, and he says he doesn't understand how it is that if the U.S. market crashes, that the stocks that we own aren't going to crash as well. Well, first of all, you have to remember, I am not expecting the U.S. market to crash. I don't think the Fed will let it crash. I think if the market is down anywhere near 10%, the Fed's going to ease, simply based on the market going down. So the Fed is going to put a floor beneath the market. And so I don't expect the market to crash. I do expect it to go down, but I don't expect it to crash. And I think what's happening is money is going to be flowing out of U.S. assets into foreign assets, into the markets that we own, which are significantly cheaper and have much more value than U.S. markets. Now, if the U.S. market does crash, like, crashes, like, goes down, right, a big move, 20, 30, 40, 50% in a couple of months, yes, all the stocks except our gold stocks are going to go down. I think our gold stocks will go up enough that the average, some of the portfolios will still go up. But I also expect the dollar to go down. And as I said, the dollar going down will offset stocks going down. I can't see the dollar rallying if the market is crashing. In fact, if you look at the correlation, the dollar tends to go down when the market goes down, and dollar goes up when the market goes up. So if we have a big move down in the market, we're going to have a big move down in the dollar, and that is going to be a bigger boost to our portfolios than the stock going up, because there's two components to every stock that we own. It's the stock price and it's the foreign exchange rate. And the foreign exchange rate is going to be much more important, because the real crash that I expect is going to happen in the dollar. And it's not going to start off as a crash. The dollar index is not going to crash from 120. When it might crash is when it's down at 70 or 60, right? We're going to crash from much lower levels. That's what's going to happen. See, we avoided that in 2008. The dollar didn't crash. It actually got saved by the financial crisis. It rallied. It got saved by the bell. The next time the dollar is going down for the count, it's not going to get saved by the bell. It's going to turn into a crisis, right, at some point. But initially, the dollar going down is going to be received as a good thing. Trump is going to be, this is great, right? The dollar is weakening, right? But, the dollar went down from 2001 to 2007. When did we have the biggest trade deficit in our history? In 2007 and 2008. The weak dollar did not turn our trade balance around, and it's not going to do it this time either, right? So Trump thinks, it's going to be a magic. If we just have a weak dollar, we'll have better exports, and our manufacturing is going to get revived. No, it's not. That's not going to do it. And ultimately, though, it's going to be the current account that's going to explode, because now we owe foreigners. They have so many treasuries, and when interest rates go up and the net outflows to service that debt, in addition to our rising trade deficits, because when the dollar goes down, it costs us more money to import. We have to import because we don't make the stuff ourselves. We have no choice but to import it. And so if it costs us more, the trade deficit is going to go up. So the crash that we need to worry about is the dollar crashing. That's the crash that's going to happen. I'm much more worried about the dollar crashing than the stock market crashing. Yes, the Dow lost 50% of its value twice in the last 17 years. And if the Fed is dumb enough, to keep hiking rates, maybe it can go down that much again. But I don't think they will let it. I think if you look at the history of the Fed, every time the market starts to go down, they backtrack from hikes. And it's only when the market is rising that they have the courage to hike rates, because they're more concerned about the stock market. That's really the data they depend on. It's not the economy. It's all the stock market, stupid. They're looking at it. It's the asset bubble. They're trying to nurture this bubble because that's really all they've got going to camouflage how weak the economy is. So I think our portfolios are positioned very, very well. The only reason that they did poorly in 2013, 2014, 2015 was because of the huge rise in the dollar. There is no other reason. And that dollar rise is over. And now we're going to have the dollar collapse. So what other questions do we have?
Okay. I have somebody asking, in addition to my Europac IRA, and I will continue to send in money, I invest in my company's 401k because they match the contribution. So in general terms, what would you recommend in kind of these plain vanilla investment products if you see in a 401k in order to try to minimize downside?
Yeah, it's always a good thing when your employer matches, because now you can lose 50% and you still haven't lost your money yet. But take a look at the options you have. If you can exclude a U.S., if there's an international option, go for that. If there's a gold option, or go for that. If you only have U.S., then try to get multinationals. Try to find U.S. stocks that will go down the least. Because you still could be ahead because of the matching. But try to get as close a portfolio as you can to us. You won't be able to get exactly. My funds are pretty unique. My strategy is pretty unique. But if you can get into emerging markets, if you get into developed markets, a lot of these plans do have those options. Just pick those.
Okay. This next question is asking what you have to say in regards to Donald Trump's statement today that he prefers a low interest rate policy. And that he also believes the U.S. dollar is overvalued. I believe you had already said that in the past. What do you think about that going forward?
Well, he's right. The dollar is overvalued, but the dollar going down is not going to be the panacea that Trump believes. I mean, the overvalued dollar is what's artificially propping up our standard of living. You know, Trump talks about how we lose on trade with our trade deficits. But in the short run, we benefit from the trade deficits because we get to live beyond our means. We get to consume without producing. You know, it's like having a job. You get your paycheck, but you don't have to show up, right? I mean, so you have a deficit, right? You're getting paid, but you're not working. It's your employer who's the sucker. You know, he's paying you. You're not adding any value. But in the long run, you know, you're going to get fired when your boss figures this out. And that's what's going to happen. I mean, our trading partners are subsidizing us. Now, they think they're getting paid. They're getting our bonds. You know, they're buying our stocks. They're buying our real estate. So they're investing the trade surpluses they have. And so they're accumulating assets while we accumulate liabilities. So they are exporting themselves rich and we're importing ourselves broke. But ultimately, we're going to default because the dollar is going to crash. We can't pay a lot of these liabilities. But, you know, this is all short term. In the short run, we benefit from the trade deficits because we get a higher standard of living. But in the long run, we suffer because we're going into debt to subsidize that standard of living. Just like an individual who decides to take out a second mortgage on his house and max out his credit cards so he can buy a nice car and take a vacation and eat at nicer restaurants. Yes, it's fun while it lasts until, you know, your debts catch up to you and then you go bankrupt. So anything that reduces the trade deficit is actually going to impose short-term pain on the American economy. Now, I'm all for that. We need that. We need that therapy. Just like a drug addict needs to go and experience withdrawal. He needs to go to rehab. But Trump doesn't get that. Nobody gets that. He's promising instant, you know, a gain. You know, I'm going to make everything great. He has not prepared the electorate for the austerity, for the short-term sacrifice. This economy is so screwed up. We are so levered up. We have had the biggest dose of this monetary morphine that has ever been. I mean, this is the biggest bubble. This economy has never been this screwed up. And there is no way to put the pieces back together again without some major short-term pain that no politician, least of all Trump, is going to allow on his watch. And this is what's going to bring the Republicans and Democrats together, trying to kick this can down the road one more time with, you know, a fatal dose of stimulus that we're going to overdose on, and we're going to end up in a currency crisis. We're going to end up, you know, as a choice between hyperinflation or finally crashing everything. And that, I don't know, that might be another 2 or 3 years away. We'll see. But it's coming. But, you know, in the meantime, Trump says he wants a weaker dollar. He's going to get a weaker dollar, right? This is the first time we have a president with a weak dollar policy. Well, the dollar went down dramatically from 01 to 07 when we had a strong dollar policy. So if we can have a major decline in the dollar when we have a strong dollar policy, imagine how much more the dollar is going to go down when we actually want it to go down, when we actually have a weak dollar policy. So as I said earlier in this, I am so 100% confident that we are on the verge of a major move in the dollar, a huge move up in gold. I mean, we are going to blow through that $1,900 high that we made in 2011. I mean, people are going to be absolutely shocked at how high gold gets. But the thing is, when the big institutions that blew out of gold, right, they didn't even get into gold. I was in gold below 300, and I rode it all the way up to 1900. You know, I never sold, but, you know, I didn't buy any up there. I bought a lot of gold cheap. But the institutions, the big money, didn't even get into gold until it was like 14, 15, 1600. They're the ones that drove it up to 1900. And then when they were convinced that the Fed solved all the problems and everything was a success and all the people like me were wrong and all the warnings about the dire consequences of QE and 0% rates, they all dumped their gold. That's why it went from 1900 to 1100. And they dumped their gold stocks. Well, when those people decide they want to get back into this trade, look out. because almost all the gold that they dumped on the market in 2012, 2013 is in foreign central banks. That gold is not for sale at any price. There's not a lot of real supply out there. Gold stocks are super cheap. So when the hedge funds and the endowments and the leverage speculators want a piece of these gold stocks, they're going to have to pay through the nose to get it. And, I'm not a seller. If my gold stocks doubled or tripled, I'm still not a seller. And there are a lot of people that aren't going to be sellers. So prices are going to have to go a lot higher. And, you could sit back and you can watch your account go up 50 or 100%, and then you can add to it. Because you know what? It won't be too late. This is still so early in this cycle. This is going to go on, I think, for years. I think the gains are going to be absolutely enormous. So you can wait if you're still not convinced. If looking at what's happened this year or last year is not enough, you can wait. And you can let another 6 months go by, another year go by, and watch the gains and then say, okay, I'm going to add to my account. Or you can do yourself a favor and do it now. The sooner you do it, the better. Because, the money that comes in now, is so much more valuable. Because let's say you wait for the markets to double or the dollar to go down 20% and these foreign stocks double or more, and then you add money. You don't just miss out on those gains, but you miss out on the compounding of those gains with future gains. So, the more money that you can add while the dollar is still high and while, some of these stocks are still lower than they were a few years ago, even though they've come back in the last year and a half, they could still be lower than they were 3-4 years ago. This money, the money that you get in, the money that you put in last year, anybody that added to their accounts last year, those additions, that money is going to be so meaningful in the compounding returns, 5 years from now. So do yourself a favor, understand this, and just take advantage of it.
Okay, thanks, Peter. So we're getting a lot of questions on real estate. I have 3 in already, and they're basically asking, what do you think about real estate right now with interest rates potentially rising, demand declining, but at the same time, Trump could get rid of a lot of regulation on the banks and so on and so forth. What's your view on real estate? Should people be buying or selling?
Look, there isn't going to be a lot of deregulation. I mean, that's just all a bunch of hype. It's not happening. I mean, they couldn't even get rid of Obamacare, right? I mean, and so, these regulations all have constituencies, a lot, so I don't look for a lot of regulatory relief. I don't think that there's going to be as much regulation added to the register under Trump as we had under Obama, but I don't believe that we're going to get any relief in that. The regulations are going to be rolled back significantly. So that aspect of it isn't going to happen. But as far as real estate, look, real estate is still in a bubble. Even though home ownership is at a 60-year low, or the lowest, whatever it is, this is not the same bubble as we had before. The bubble we had that popped in 2007, that was, you're a fireman married to a school teacher. They had 5 homes, right? They were using liar's loans, nothing down, teaser rates on their subprime mortgages, right? That's not what's really going on right now. The reason there's a housing bubble is because in 2009 and 10 and 11, all the hedge funds, or a number of hedge funds and private equity funds, bought up a lot of single-family houses on spec. Just bought them up. They had huge portfolios of single-family homes. And their plan was to buy them now and then own them for a few years, rent them out, and then eventually they were going to sell the properties to their tenants who were renting them. That's what they said. If you go back and read what they were saying they were going to do, that was their plan. I said back then, never going to happen. And it hasn't happened. The renters cannot afford, they don't have the income, they don't have the savings, they don't have the down payments, they got crappy jobs, they got part-time jobs, they got no jobs. So that's not happening. There is no exit strategy. They can't sell to their tenants. They're trying to come up with ways to securitize this real estate, take it to Wall Street, liquidate it into the stock market. Look, I think that something's going to happen, and the big hedge funds that own all these properties are going to dump them. Just like a stock. Hey, they bought a stock at 50. It's not working out. It's at 25. Dump it, right? People do that. Cut your losses, right? They're going to do that because these properties are not cash flowing. especially with interest rates rising, as the economy weakens and more tenants stop making their payments. Meanwhile, they bought a lot of these houses, 6, 7, 8 years ago. They're starting to go wrong. Things are starting to break. The repair bills are mounting. You cannot manage these portfolios. It's not like having an apartment building where you have 100 units in the same building. You're talking about single-family homes spread around the United States. I mean, these guys have no experience managing property. So this is going to be a disaster. And when these guys sell, look out below. Because, in the housing bubble, when it burst, a lot of people didn't sell because they were underwater on their mortgages, and the banks would not approve a short sale. So, there was a big shadow inventory there. The foreclosures weren't being sold. But these private equity funds have no mortgages. They could just sell, and they will, for whatever price they can get. So I am not optimistic on real estate. And in fact, commercial real estate is going to be a bloodbath because the retailers are going out of business left and right. And it's not just because Americans are broke and levered up and have all this credit card debt. In fact, if you look at credit card debt over $1 trillion, student loans over $1 trillion, almost $1.5 trillion, auto loans over $1 trillion, this is people have no money to shop, and to the extent that they're shopping, they're buying on Amazon. I mean, that's why Jeff Bezos is now the second richest man in the world, and he may even pass Bill Gates. We'll see. But his fortunes are directly proportionate to the demise of the American retailer. Look what's happening to the shopping centers. Look what's happening to the malls. All this real estate is going to implode. We have more retail space per capita than any other country in the world, maybe by a factor of 10. Yet our citizens are broker. We have all this debt. So all this excess capacity, this is going to be a bloodbath. And commercial real estate is already bid up to the stratosphere with these ridiculously low cap rates based on artificially low interest rates. So two things are going to happen to the commercial real estate market. The rents are going to fall because of bankruptcies and vacancies, and interest rates are going to rise. These things are going to get crushed. So the real estate market is even more vulnerable now than it was in 2008. So be very, very careful in the real estate market. I mean, I own some real estate, but it's just because I don't think it's a good investment. I just own houses that I live in. And I look at my real estate like my cars or my boats. It's just a depreciating asset. They're money pits. Things keep going wrong. But I buy it because I can afford it and I like it. But I don't buy it to make money. If I want to make money, I'm going to buy some foreign stocks. I'm going to get some good dividends. I'm going to buy some more gold stocks. That's where I'm going to make my money. And if you want to own real estate, you can own commercial real estate in Singapore or New Zealand or Hong Kong or places like that. We own some of these property stocks. We get good dividends. That's where you want to do it. But I don't like residential real estate almost anywhere in the world. I mean, it's too expensive pretty much everywhere you look. But that won't always be the case. I mean, at some point it'll be cheap, but we're not even close to there.
Okay, thanks, Peter. So I think we have time for one more question. And this one is just asking what you think about what might take place if the Fed doesn't hike rates, but instead decides to stop reinvesting the USTs and mortgage-backed security maturities.
Yeah, the Fed is talking about that. They've been talking about doing that for 7, 8 years. The reason they haven't done it is because they can't. If the Fed doesn't roll over the maturing bonds, who's going to buy them? Somebody has to buy them because the only way the Treasury can repay the Fed is if they find somebody to loan them the money. The Treasury can't print money like the Federal Reserve. And of course, when the Federal Reserve gets the money back from the Treasury, it destroys it, right? It takes it out of circulation. It's like, if my own check comes back to me, right? I just tear it up. And so if the Federal Reserve allows its balance sheet to shrink, the money supply is going to shrink. We've never seen that. The money supply always grows. We always create inflation. So there would be such a massive collapse in the bond market and the stock market if the Fed tried to reduce its balance sheet. That's why it hasn't tried. But I think before it gets along to even bluffing by maybe like doing a tiny little trivial reduction just to kind of show that, oh yeah, we're doing it right, just to create some confidence. Before they even get to having, a cosmetic tiny reduction, they're probably going to have to ramp it up. They're going to have to do QE4. Who are they kidding? And as I said, the Chinese, the Japanese, they're shrinking. Look at the foreign holdings of U.S. Treasuries going down. I mean, how is the Fed going to sell if the other central banks are selling? The Fed's got to buy. Otherwise, bond prices are going to collapse. And then, all hell's going to break loose. Because if interest rates go up, that's it. It's lights out. Everything's going to implode. Now, that's going to happen eventually anyway. But it's only going to happen because the Fed is boxed into a corner. What's going to ultimately cause interest rates going up is the possibility of something worse than a financial crisis. Hyperinflation. It's only going to be to prevent the dollar from becoming monopoly money that the Fed is going to reluctantly jack up rates. So then, of course, that's it. But we got to be prepared for that now. This is coming. And people can say, Peter, you've been saying this for a few years. Doesn't matter, right? Whether I'm 3 or 4 or 5 years too early, in the scheme of things, my timing is great because you can't be too late. You're never going to be perfect. And in the history of things, right? I mean, this is the time period where this is going to happen. This is where all the chickens come home to roost, right? These chickens have been going out since the New Deal, right? And it got worse under the Great Society programs, and But this is it. We're going to pay the piper. It's this generation of Americans, this generation of investors that are going to have to deal with it. And so, whether it happens a few years later, hey, I mean, this is it. And we're positioned the only way you possibly can be positioned to profit from this. And so we're in the excuse me, we're exactly where we need to be. And the only thing we can do, I think, is make the positions bigger by a lot of people sent me, hey, let me send you some money, whatever percent you sent. Now's the time to say, okay, great. Now I'm going to add to my portfolio. I'm glad I kept some dry powder because now I get to use it.
Okay, great. Thanks a lot, Peter. Okay, that ends the webinar for tonight. Thanks again, everybody, for joining us, and we'll see you back here hopefully next quarter. Have a good night.